Hi, welcome back. And with me now, I've got Brad Olsen, who is going to talk about economic challenges in infrastructure. So welcome, Brad. Brad is the Principal Economist and Director at Infometrics with a focus on local economies, examining the outlook for the New Zealand economy and the economic impacts of COVID-19. As a leading economic commentator across New Zealand, he focuses on informing key decision makers and the wider public about emerging and changing trends and getting useful and understandable insights to a wide range of groups. In March 2021, he was named 2020 Young Wellingtonian of the Year. So welcome, Brad.
Claire, good afternoon to everyone else as well. You've just had a fantastic session, hopefully understanding what's happening out there across the economy and what challenges and trepidations still remain ahead. What I want to focus on for the next 20 minutes or so is highlighting two of the key challenges we see moving forward across the New Zealand economy and, of course, particularly across the construction and infrastructure sector. That's skills shortages and supply chain issues. We've seen, of course, quite a bumpy road still for the New Zealand economy. We've now got these intense labour market challenges, and it's still difficult to find the actual bits and pieces to get going and moving New Zealand's economy forward. We've seen that the unemployment rate in recent times has fallen back to the equal lowest level we have on record since the 1980s, down to 3.4% on a seasonally adjusted basis. We talk about, a tight labour market. This really is, by New Zealand standards, the tightest that we've had it. More importantly, there's no real slack still in the labour market. It's not just that we have a low unemployment rate, it's that people who are working are generally working quite a bit. We know that hours worked, even allowing for recent disruptions, are quite high. We know as well that the underutilisation rate, so taking into account people who are working but might be wanting to work a little bit more, is also low. What that tells us is that the amount of spare capacity in the economy is relatively muted, and we're starting to see those pressures rise. Of course, in the construction and infrastructure market, we've had these issues building quite rapidly in recent months. And importantly, we've also got a large amount of work to try and do, a very high level of what economists term demand. But again, that supply response from labour, but also, as I'll talk about shortly, materials, is a real challenge moving forward, and means that although there's a lot of work to be done, getting it actually completed is going to take a little bit longer than first expected. Looking across the economy and particularly around jobs, because the challenge very much is around finding the right number of people to be moving forward. You can see that if we compare the trajectory for construction generally versus the rest of the economy since about mid-2019, so a little bit pre-pandemic, you can see the divergence in fortunes, while the rest of the economy has charted a softly upwards path, but still soft path, if you will, over the last year or so. Construction has gone from strength to strength, more than 14,000 more employees over the last year as well. Again, what we're seeing there is that there's a lot of work to be done. We are adding more workers, but we're still adding them slower than what we might want to if we want to get things going. With those challenges around finding the right number of workers in the right places to do the right jobs, the challenge that is also emerging is the competition that it continues to heat up in the market, not only between different construction firms, for example, but also wider across the economy as general heat comes forward, as there's a lot of economic activity that wants to be done. And again, the scarce resources, the fewer people we have available, therefore are much more lucrative, much more commanding when it comes to pay negotiations and similar. And I highlight that because if we look at filled jobs by industry over the last year, you can see that just about all but one industry saw an increase in job numbers. So it's not just that one or two sectors are growing strongly, it's that everyone is trying to take a few more people, or a few thousand in this case. Just looking at the bottom for a second and explaining that fall in the agriculture sector, that's actually not a fall that the sector might want. That's actually where there's such specialised challenges in some of those sectors and regions that the industry has got fewer workers than usual, and again, really struggling because of it. You'll note at the top, construction there, the second largest growing jobs industry across the entire economy by total jobs added, over the last 12 months or so. Healthcare coming through strongly. There's a lot of professional activity that's wanting to happen as well. Manufacturing and then tourism sectors also looking to boost ahead. Again, it's that competition not only to try and find another builder or another engineer within the same space, it's that people have a huge amount of choice at the moment about where they put their labour, their time, their resources, and that is becoming a huge challenge for the labour market. And again, it's across the country as well. Now, what's interesting, if we look at this chart, down towards the bottom, you'll note that although there has still been gains in job activity across the entire country, you'll see that Auckland, Canterbury and Wellington, most of our major urban centres located in those areas, going at a slightly slower clip. We're seeing, though, that our more provincial centres, Northland, parts of the West Coast, the Bay of Plenty, the entire sort of eastern North Island, if you will, seeing a much stronger level of jobs activity. And again, what we're seeing at the moment is that the rebound in economic momentum to try and pull more people into jobs is very much getting us into that scarce resources territory. And the challenge remains when businesses are looking out there to find staff, it's incredibly difficult to do so. But what I want to highlight here is that's not particularly niche to any certain region or industry. It's across the board, and that's actually adding an increasingly complex layer because people have so much choice about where to go. What that's meaning is that the wage pressures are turning up. Now, we've got a lot of different ways to measure how much we pay people. This is one that you might not have seen before. This is total earnings from employees divided by the number of filled jobs. Now, I use this because the other wage measures that we often look at either try and correct for the sorts of roles that people do or how many hours they work and similar. This here is the total amount of cash that businesses across New Zealand are paying divided by the number of jobs that they've got on the books. And you'll see there in recent times the over 6% boost in earnings per filled job coming through very strongly at a time that we're adding more and more workers. That there is highlighting those cost pressures. More importantly, we're not about to see that stop in my mind. You'll continue to see those higher pressures on labour as we head forward with no real end in sight for trying to address the challenges, those skill shortages that we have. We know that job ads remain in an incredibly firm position. You can see here, stretching all the way back to the early 1990s, that job ad figures just at rather strong levels. Particularly moving forward, the challenges are going to be that we've got a lot of job ads available, but the number of people who are looking at those job ads and trying to sign up are a lot lower. So again, the challenges to fill those spaces and get more activity going will not only be what they are now, but they will persist heading into the future. NZIER's quarterly survey of business opinion has shown that businesses are now reporting the most difficult period on record to find workers since the question was first asked in the 1970s. And again, what we're seeing there is those pressures have built to such an intense level that finding the right people is an incredible challenge. We, of course, don't have international migration coming in, as I'll highlight in a second. But we're also seeing that more people are starting to move around in their jobs. And again, the pressures not only in construction and infrastructure, but in a number of other sectors means that the leakage in and out is challenging, and finding the right skills in the right places to do the right jobs has never been harder. More importantly, and this really has been the stunning one for me, we've been seeing the labour market tightening before now. What we are starting to see, what we've heard businesses report, is at the moment you're seeing the highest levels of labour turnover on record since the 70s. Now, that previous chart I showed you had quite a few periods where we did see labour tightness coming in, difficulty finding workers creeping up. You'll see here that the current level of labour turnover, poaching, if you will, where people are going to nab another worker, is incredibly higher than it's ever been before. That means that businesses are not only having to pay more to try and attract new staff, but they're having to pay a lot more just to try and keep the current people in their organisation. And that's very difficult moving forward, with one arm trying to reach forward and another one trying to hold your current crew back from leaving. Again, pressures abound in the labour market, but it's not just trying to find new, it's actually trying to keep your current levels and having to limit that replacement that you might see. That's really because we have seen a huge drop in net migration. I mean, the figures really speak for themselves here. You'll note also Infometrics estimates moving forward is that even though we do expect a revival in migration activity, it's still nowhere near what we saw pre-pandemic. We have upgraded our estimates a touch with that orange line there for October, including the 2021 resident visa. At the same time, though, that's really just fewer people who might leave and stop some of that brain drain that we've been concerned about. The issue in our mind is that actually bringing more people into New Zealand is likely to be significantly challenged. We know that the number of Kiwis who are still here in New Zealand who would normally have gone overseas is quite high, and we do risk seeing more of them flow out as borders start to reopen. But with challenges remaining around the MIQ system and with the government not making commitments yet around opening things up nearly as fast as I think a number of people have been wanting or asking for, again, we see the risk that New Zealand is seen to be hard to get into but easier to get away from, and again, keeping those net migration levels at a much softer level. And that's important because at the moment, we've got no one who's coming in who's available to work. Our population growth at the moment you'll see both the under 15s and the working age population 15 to 64 are barely existent. Numbers out today show that total net migration over the last 12 months is sitting at 800 people. That's 3 digits, not the usual 5. More importantly, we know that the growth still at the moment is in that 65 plus age group, with the aging population and the retiring focus, meaning again, you're having the challenge of finding it really difficult to find a new worker at the same time as having to try and keep hold of your current workers, and at the same time as trying to replace your aging, retiring population in some areas. Construction is no different. The challenge is still finding workers is difficult. But again, it's not just pure numbers here. It's very much trying to find the right people in the right spaces to do the right work. We still have over 190,000 people on a job seeker benefit across the country, nearly 50,000 more than what we had pre-pandemic. It's not that we don't have enough people, is that those skills don't overlap. We have a bunch of people still on job seeker who are invariably wanting work but can't quite make it onto the job site, haven't got the full equipment, the full needs and skills and requirements. There needs to be and will be continued work to try and bring this group into action. But it's not simple enough to say that we don't have enough people in New Zealand to do the work we do. We don't have them with the right skills in the right places to do the right work. Moving forward, we continue to see a very healthy pipeline of activity. We know that, of course, residential activity and non-residential commercial building still going stronger. And our own estimates of other construction, that's the Stats NZ term for civil infrastructure, if you will, you can see in volume terms continuing to move higher as we head forward. That's a very healthy, very solid pipeline of work that we see coming from generally the public sector at the moment. That is going to continue to keep these pressures on. There is no real relief in sight. More importantly, and I show you these figures, they are residential construction costs, but they give you a good flavour of how intense the cost pressures have been in recent times. Over the last 6 months, residential costs have risen 9%, and you'll see that they are the hottest period of inflationary pressure in the building sector in quite a long time. And again, that's making it very difficult with finding materials, getting work done, incredibly challenging. More importantly, as we profiled this morning in Newsroom, we've highlighted that provincial centres are seeing some quite intense pressures on inflation and pricing. What that's suggesting is that although we've still had a relatively good bounce back across the entire economy, we've also had a much stronger bounce back in parts of provincial New Zealand, particularly the provincial North Island. With a lot more economic activity, the pressure, the scarcity of resources, both people and things, materials to build with and similar, means that those cost pressures are coming up even hotter because of that competition, that intense competition to find the right stuff. Moving forward, we continue to expect that cost escalation remains high. You'll see our forecast here for the civil construction sector averaging around about 2 to 3 to 4% over the next 5 years or so, after coming off a very high peak of over 5% towards the end of this year. The challenge as well, as you'll see from this chart, is that, again, there's no real end to this challenge to the pricing pressures that are intense across the economy. And with those pressures still intensifying in other sectors as inflation catches up, general inflation that is, we are likely to see those challenges remain when it comes to actually not only getting work done, but work done to the right standard, at the right cost, at the right time. One of the massive challenges emerging because of or resulting from the pandemic and starting to hit costs is at the moment you're paying 10 times more than normal for a container. And you'll note, thankfully, in a sense, that in recent, the last 2 to 3 months, we've seen that freight container prices have somewhat leveled off. But again, they've leveled off at around about 10% higher. We see it very hard to believe that freight costs all of a sudden drop back to normal anytime soon. And in fact, we see it to be another 18 to 24 months before things really start to turn around. One of the challenges is we've got a lot of boats that are starting to move across the world, but actually trying to find the port space to bring stuff into is becoming more difficult as days go by. In fact, recently, the Port of Los Angeles had, I think, something like a 30-day wait at anchor outside of it as they tried to get more stuff off ships. So it's a challenge that we're likely to see persist for a long time. What we're seeing because of that is that businesses are having to order considerably more, considerably further ahead in the process to make sure they have the goods available, the material inputs that they need when it comes time to do the project. We're not seeing a huge amount of stockpiling, which might surprise some people, but that's more because we're actually trying to backfill the stuff we haven't been able to do in previous months. And a number of businesses that we're talking to have highlighted that they are buying a larger level of stock, not necessarily so that they can stockpile it, but so that it's ready to go for a specific project. And when it eventually arrives, hopefully that project can get underway. You can see quite clearly here why we have that challenge. The value of total sea imports over the last year, thankfully in recent times getting back towards normal, but you'll see there's a pretty impressive hole to get through, which means that things that are arriving now are really stuff that we wanted probably about 6 months ago in many regards. And so again, the pressures, the flow-on effects mean that the pushing out of timeframes on building projects and similar are likely to continue. And we expect that many more businesses will be looking to renegotiate exactly what they're getting, at what price, at what time. We're seeing the inflationary pressures across the economy are growing. You'll see here our estimates before the latest inflationary result coming out and expecting inflation to still pop quite a bit higher. Heading forward, we're likely to revise this number not only up to above 5% for general inflation, but also likely to hold it for longer. That orange line sort of sitting up at that higher cost pressure level for a while longer. What I do want to profile for the sector is remember also what sort of costs you are enduring. We talk a lot, particularly in the media, but sometimes in contracts as well, about the consumer's price index. Now, that's good if you're buying a bit of fruit and vegetables. Maybe you're renting a house and perhaps buying a mobile phone. If you're buying bitumen, steel, pipes and labour, your CPI is no longer fit for purpose, and it's important to have a look at those other indices that are published and consider much more where futures and similar are heading for some of your cost inputs, because we're seeing not only high price rises, but considerable volatility and variability in pricing across the economy, particularly with concerns rising about the Chinese output. The Chinese economy was going strong, has softened back in recent times. Power challenges and energy production prices across the entire globe starting to hit, but also this extreme uncertainty that's been brought about by the Evergrande challenges, also very much making some uneasy and seeing some considerable volatility in outputs coming through from China. All of those pressures mean that it is going to get more expensive to borrow. And so coupled with the challenges of finding labour heading forward, not only trying to keep the people you have, but also trying to bring in new folk, as well as those material challenges, finding the right materials at the right price at the right time. Interest rates are also starting to head up as the Reserve Bank tries to temper back some of that activity. And at the moment, we have an uncomfortable position where we have not only significant supply issues around materials, supply chain disruptions, and labour supply and similar, We've also got huge challenges with high levels of demand, even though we have had a setback with the Delta outbreak. Generally, across the rest of the economy outside of Auckland and Waikato, we are seeing very high levels still of bounce back activity. Not quite as firm as we saw after the first lockdown, but a bounce back nonetheless. That intense demand pressure, coupled with an inability to supply enough labour or goods to meet that demand, means that we are in this very uncomfortable position. We're bidding up the price to make sure that your thing gets going and someone else's therefore has to miss out, is becoming more and more usual. The challenges that we are likely to see heading forward are likely to be more of the same, but again, with that intensity persisting for a longer period. New Zealand and parts of the world are now in the highest inflationary pressure environment we've seen for over a decade. Finding the right workers to do the right jobs is incredibly difficult, and we see a challenging time ahead, not only to get work done and get it underway, but also to make it come in on budget or around budget, with those pricing pressures and actually the ability to deliver in totality a real challenge moving forward. With that, Claire, very happy to hand back to you, and I hope everyone enjoys the rest of the symposium.
Thanks, Brad. I appreciate that. Now we are just moving into our next session. So if you want to end this, we've now got a session on funding and finance and economic recovery. So thank you, and thank you again, Brad.